Brad Williams, Frugal Finance, rewarded and unrewarded risk. Risk, as previously defined in the previous section, comes from the difference of actual returns from expected returns. This difference, however, can happen for any number of reasons, and these reasons can be identified in two categories: that specific to the investment under consideration, called company-specific risk, and those relevant to most or all other investments, market risk. Risk: when a company makes an investment in a new asset or project, the return on that investment can be influenced by a number of variables, many of which are not under the complete power of the company. Much of the risk extends directly from the investment, a fraction from competition, some from changes in the industry, some from movements in exchange rates, and a lot from macro factors. A piece of this risk, nonetheless, will be reduced by the company by adding multiple investments or projects, and another piece by investors as they hold diversified portfolios. The first source of risk is project specific. A single project may have higher or lower cash flows than anticipated, either because the company miscalculated the cash flows for that project or because of reasons exclusive to that project. If companies take a large number of identical projects, it can be reasoned that most of this risk can be diversified away in the ordinary course of business. For example, Granite Construction, while considering a new construction project, exposes itself to estimation error. It may under or even overestimate the cost and time of completing the project, and may also err in its estimates of revenue from both time and cost of materials. Since Granite Construction completes hundreds of construction projects a year, it can be argued that some or most of this project risk can be diversifiable across projects during the course of the year. The second source of risk is competitive risk, when the earnings and cash flows on projects are influenced positively or negatively by the actions of competitors. Whereas a high-quality project analysis will support the anticipated response of competitors into estimates of profit margins and growth, the tangible responses taken by competitors can diverge from these expectations. In many cases, this element of risk will influence more than a single project, and it is harder to diversify away in the day-to-day operations by the company. Granite Construction, for instance, in its review of revenues from its transportation division, may err in its judgment on the strengths and weaknesses of its competitors, like Flatiron. While Granite Construction cannot diversify away its competitive risk, stockholders in Granite Construction can, if they're willing to hold stock in the competition or competitor stock. The third source of risk is industry-specific risk, the things that affect the earnings and cash flows of a specific industry. There are three sources of industry-specific risk. The first is technology risk, which reflects the effects of technologies that change or evolve in ways different from those expected when a project was originally analyzed. The second source is legal risk, which reflects the effects of changing laws and regulations. The third is commodity risk, which highlights the impact of price changes in commodities and services that are used or produced disproportionately by a specific industry. Granite Construction, for instance, in evaluating the outlook of its water division, is likely to be exposed to all three risks: to technology risks, as the lines between engineering and infrastructure are increasingly blurred by companies like Fluor Engineering; to legal risk, as the laws governing building and safety change; and to commodity risk, as the cost of building and construction materials change over time. A company cannot diversify away its industry-specific risk without diversifying across industries, either with new projects or through acquisition. Stockholders in the company to be able to diversify away industry-specific risk by holding portfolios of stock from different industries. The fourth source of risk is international risk. A company faces this type of risk when it generates revenue or has a cost outside its domestic market. In such cases, the earnings and cash flow will be impacted by volatile exchange rate instability or by political developments. Granite Construction, for instance, is clearly exposed to this risk with its constructions division in Mexico. Some of this risk may be diversified away by the company in the everyday course of business by investing in projects in different countries whose currencies may not all move in the same direction. Jacob Engineering, for instance, operates in many different countries and should be able to diversify away some, though not all, of its exposure to international risk. Companies can also reduce their exposure to the exchange rate component of the risk by borrowing in the local currency to fund projects. Investors should be able to reduce their exposure to international risk by diversifying globally. The final source of risk is market risk. Macroeconomic factors that impact nearly every company and all projects to some degree. For example, movements in interest rates will have an effect on the value of projects previously taken and those yet to be taken, both directly through the discount rate and indirectly through the cash flows. Other variables that shape all investments include the term structure, the difference between short and long-term rates, the risk preference of investors as investors become more risk averse. More risky investments will lose value, inflation, and economic growth. While expected values of all these variables enter into project analysis, unanticipated movements in these variables will change the value of these investments. Neither investor nor companies can diversify away this risk because all risky investments bear some exposure to this risk. Why diversification reduces or eliminates company-specific risk. Why do we single out the different types of risk? Risk that impacts one of a few companies, i.e. company-specific, can be lower or even removed by investors as they hold more diverse portfolios due to two reasons. The first is that all investments in a diversified portfolio is much lower percentage of that portfolio. So any risk that improves or lowers the value of only that investment or a small set of investments will have only a minimal impact on the total portfolio. The second is that the results of company-specific actions on the prices of individual assets in a portfolio can be either good or bad for each investment for any time period. So, in a large portfolio, it can be stated that this risk will average out to be zero and therefore not affect total value of the portfolio. In contrast, risk that impacts nearly all assets in the market will continue to persist even in large and diversified portfolios. For example, higher interest rates will generally lower the values of nearly all assets in a portfolio. Image 1.5 sums up the different prices of risk and the actions that can be taken by the company and its investors to lessen or remove this risk. While the intuition for diversification and elimination risk is straightforward, the advantage of diversification can also be graphed statistically. In the previous section, we presented the standard deviation as a measure of risk in an asset and computed the standard deviation for an individual stock, Granite Construction. When you combine two investments that do not move up and down together in a portfolio, standard deviation of the two investments can be greater than the standard deviation of the individual stock itself. To observe how the math of diversification works, let's look at a portfolio of two assets. Asset A has an expected return of mean of A and a variance in returns of standard deviation A, while asset B has an expected return to mean of B and a variance of returns of, or variance B. The correlation in returns between the two assets, which measures how the assets move up and down together, is P A of B, portfolio A of B. The expected returns and variance of the two asset portfolios can be written as a function of these inputs in the proportion of the portfolio going to each asset. A portfolio A and A plus 1 minus W, or the variance gives you this, where A is equal proportion of the portfolio A. The last term in the variance formulation is sometimes written in terms of the covariance and returns between two assets. This may seem new to a lot of you. If so, I go over this time and time and time again in the portfolio of courses that I've provided. So if you're stumped here, this is Finance 101. This is one of the first things we learn is about variance and covariance and correlation, standard deviation and variance, and all the fundamentals of Finance 1A. My suggestion is, if you're stumbling, pick up a basic finance book and just review it. Here we have the savings that accrue from diversification are a function of the correlation coefficient. Other things remaining equal, the higher the correlation in returns between the two assets, the smaller are the potential benefits from diversification. The next example shows the benefit from diversification. Brad Williams, Frugal Finance. Thanks for watching.